In this presentation, you'll learn about planning for clients with special situational needs. By the end of this lesson, you should be able to describe life transitions and special situations that may impact your client. Understand how to plan for the unique circumstances associated with life transitions and special situations. And discuss emotional issues confronted by clients during life transition. Transitions within a person's life often serve as the trigger that motivates the client to seek financial planning help. As described by Nancy Ophelia, you hear this from planners all the time. People just don't wake up one morning and decide to go see a financial planner. Very often, it's a life-changing event that brings them to the door. While we know that each of our clients is unique, there are commonalities associated with life transitions and special circumstances that help us in our planning endeavors. Transition is a reality of life, and examples of normal transitions are marriage, birth of a child, that change in the parent-dependent-child relationship, which we often refer to as empty nest, loss of a parent or parents, moving, which can cause a loss of community, nearing of retirement, transition into retirement, aging, or failing health. Special circumstances are not ubiquitous across all clients. However, many do face these types of transitions. Special situations that are described in the CFP curriculum include divorce, loss of a spouse, a widower, a disability, terminal illness, non-traditional families such as second marriages, single parents, unwed life partners, a job loss or job change, dependents with special needs, monetary windfalls, and caring for aging parents. We might also consider the purchase, sale, or loss of a family business as another type of special situation. In helping a client plan for a special situation, you will still be assessing the needs across each of the core planning areas: cash and debt management, planning for educational needs, insurance and risk management, income tax strategy, retirement planning, investments, and estate planning. Where is the client's current plan strong? Where is there a weakness or a gap? As you progress through the core financial planning courses in this MBA program, you'll learn about different strategies and products to do this. However, for purposes of providing a frame for the type of analysis you'll be doing, let's look at a couple examples. There are several unique priorities in each of the planning areas that need to be addressed during and following a divorce. On this slide, you see several unique planning issues in the areas of the planning process: cash management, risk management and insurance, and investment planning. On the next slide, you'll discover issues in the area of tax planning, retirement planning, and estate planning. Notice that all the basic building blocks of the comprehensive plan are addressed. However, there are certain elements that are specific and perhaps unique to this special circumstance. The planning process. As discussed in week 1 of this course, the first step in the financial planning process is to help the client define their goals, which will most likely change following a divorce. You need to then collect data related to divorce proceedings, such as the actual division of assets and liabilities, the divorce settlement paperwork, such as the qualified domestic relations order. With a new identity, your client may have to notify the Social Security Administration and their employer of a name change. For that matter, emergency contact information will probably need to be changed. Cash management, budgeting, and cash flow management involves analyzing the after divorce earnings and expenses. Part of that cash flow picture may include alimony payments and child support. Risk management. Current insurance policies will need to be reviewed, titling changed, and coverages modified. Your clients may be able to take advantage of the ex-spouse's employer health care benefits by electing COBRA healthcare continuation coverage, because divorce is a qualifying event for COBRA. Beneficiaries of life and annuity contracts may have to be redesignated. It's important to also check to see who will be making the subsequent premium payments on life insurance policies. Investment planning. Separate banking accounts may need to be established and any joint brokerage accounts retitled or closed. A settlement of net worth, a statement of net worth may be needed for the court separation proceedings. Once completed, the financial planner will have to reassess the client's objectives, risk tolerances, preferences and constraints in reallocating the investment portfolio. Income tax planning. There are several possible tax planning implications with the divorce. First, there may be court-ordered alimony. Alimony is a deduction from gross income for the payer and in addition to gross income for the payee. Note that child support is never deductible for the payer or taxable to the payee. Second, the single parent acting as custodian for the child will be able to claim the tax exemption and possibly take advantage of tax credits. Next, the sale of property for purposes of division among the two adults or the sale of property subsequent to the settlement may generate capital gain recognition. Note that there's no gain or loss on property settlements between the two spouses, just upon that sale of property to the third person. Check with the client's CPA to determine any other tax consequences accompanying the divorce. Retirement planning. Retirement plans are often impacted by the terms of the divorce. And in some cases, the portion of qualified assets may be rolled over to your client's IRA account or out of your client's IRA account. The financial planner will need to assess the impact of the divorce settlement on retirement assets, review beneficiary designations, and determine Social Security benefit projections. Estate planning. Estate planning documents, including the will, the durable power of attorney for financial matters and for health care, and the advanced health care directives need to be updated. Property titling should be checked and modified as appropriate. An estate lawyer may have to be consulted in regards to how the property may be transferred to minors, such as in a living trust, if that is an issue. Financial planning priorities following a divorce tend to be 1. Assess cash flows and its impact on your client's continued lifestyle, and 2. Transferring title and changing beneficiary designations. The non-traditional family is single parent. In general, one-parent households tend to have lower than average income, and some are dependent on welfare assistance programs. It follows, therefore, that one of the primary challenges of planning for single parents deals with cash management, establishing a workable budget, and generating systematic savings. Important pieces of the budgeting puzzle for divorced or single parents include cost of childcare while the single parent is working, planning for the child's education. If this situation is a result of the divorce, there may be issues of reliance on alimony and child support payments and the risk that that child support payment might be skipped. Because cash flow is often the weak link in the plan, any disruption of those cash flows can have a serious impact. Long-term disability insurance is a priority to ensure the continuance of cash flow if the single parent is incapable of working. Life insurance is needed to provide a safety net in the event the single parent passes away prematurely. The single parent caring for a child does have some tax relief. This benefit includes an income tax exemption, child-related expenses that could be itemized as deductions, and possible tax credits. The planning priorities for single parents are: 1, ensure there's a current will that identifies the guardianship of the child, and 2, purchase sufficient insurance for the child's continued support and well-being in the event of disability or death of the single parent. Life transitions and special circumstances have a common element. They put the client under stress. William Anderson and Shelley Lee wrote the following in their article, The Financial Psychology of 4 Life-Changing Events. Financial planners traditionally have approached their work for clients in a rational, analytical way that helps meet specific, concrete goals and objectives. A retirement nest egg, a college savings plan, a long-term care contingency plan, or an estate plan that takes maximum advantage of tax incentives. But clients in crisis are more focused on their pain than their portfolio. People who have experienced an unexpected departure from life's plan are thrown off balance by new, unfamiliar, and often unwelcome emotions. Grief is a natural reaction to the loss of a person, such as the death of a spouse, a family member, or an impending loss with a terminal illness. Loss of a dream, such as from a divorce, career loss, lifestyle change, or loss of property, a home, investments, a business. Healing requires a process that requires first coming to grips with the loss, dealing with the uncertainty and confusion, and finally redefining oneself. This transformational process takes time. In helping the client work through the loss, the planner must bring both technical competence and human compassion. A grieving client will typically experience an intense range of emotions, including denial, anger, guilt, confusion, anxiety, depression, loss of identity. At some point, those emotions will hopefully give way to acceptance, improved confidence, and a new sense of self. In a well-received presentation at the FPA convention called Concrete Tips for Working with Grieving Clients, Elizabeth Palamica, a certified financial planner and grief recovery specialist, shared the following. Your job is not to make the person feel better about their loss. Don't even try. Rather, the role of the planner is to first listen, hearing what the client is saying and acknowledging that the emotions of grief are normal. From the financial planning perspective, the first priority is to deal with short-term needs, food, fixed living expenses, and personal needs. Providing the client with assurance that their financial condition is sufficient to maintain their prior lifestyle, or making specific changes to ensure that basic living needs are taken care of, is extremely valuable for the grieving client. A short or one-item to-do list is appropriate. Before focusing on long-term planning, it's necessary to respect the client's grieving process. A general rule of thumb is to suggest to the client that major decisions be postponed a year. However, psychological research confirms that the grieving process may extend well beyond that one-year horizon. Starting over is a highly emotional challenge. As a financial planner, you can help the transition by recommending patience when it comes to making major decisions, prioritizing to-do activities such as cash flows for non-discretionary expenditures, recommending community resources or professionals that can help the client forge a new sense of identity, Quoting Susan K. Bradley, founder of Sudden Money Institute, people in transition need to redefine themselves. Frequently, there's that loss of self-identity. Let's take a moment to think about planning for the client who receives a monetary windfall. In working with a client that received this monetary windfall, the financial planner needs to help the person clarify their goals. Do they want to continue working? Do they want to explore a new career? Do they want to redefine their lifestyle expectations? The client may need to take some time to clarify their objectives and discover a new sense of self. Your coaching of the client on how to handle requests from family, friends, and brokers could be extremely valuable to the client. Cash management issues include budgeting for the new economic reality, creating a statement of net worth, and paying off debts. While all insurance coverages will want to be examined, especially if the new assets are purchased, the current level of liability exposure will most likely need to be raised. At some point, there'll be the need for a complete investment plan. That plan needs to address diversification issues, appropriate asset allocations, security selections and implementation. An investment policy statement should be written. There are immediate tax implications from the windfall. First, taxes will most likely be due on the receipt of the sudden money. If the client ends up gifting significant assets to family members or friends that come knocking on his or her door, then there may be gift tax consequences. Estate planning documents will need to be updated, and estate planning strategies such as trusts may need to be considered. Other things that you may do to help your client transition are help the client define their new goals and direction. Help the client take small steps that will give them confidence in making decisions and taking action. Work with the client to establish reasonable boundaries. For example, boundaries that may prevent spending sprees. Create financial statements and performance statements that will help the client understand their new economic reality. And develop strategies that could be used to make future financial decisions. In this lesson, you learned about types of life transitions and special situations, planning for transition and special situations, and emotional issues that accompany life transitions and special situations.